Welcome, everybody. Let's talk real estate. Your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California. As we take a no BS look at both sides of the issues driving this market today to find the best solutions going forward. With our man right in the middle, it's Barry Saywitz. Hey, Barry.
Hey, good morning, Paul, and good morning to all of our viewers and our listeners out there. And if it's Tuesday, which it is, we are talking real estate. I am Barry Saywitz, president of the Saywitz Company and managing partner of Saywitz Properties. And if it's one thing I've learned in my 30-plus years of doing this, it's to get good information, make good decisions, stay out of trouble, take your vitamins, and hopefully have a good day. And so I'm excited about today's show, as always, but we have a special guest with us. But before we get to our guest, I do want to have a quick and special shout out. Today is the birthday of my favorite and only living aunt. So happy birthday, Aunt Sandy. Tomorrow is the 80th birthday for my father. So happy birthday to my father. We're glad both of you are still with us and kicking. I won't say how old they are, but let's just say they're older than me and less than 100. And so with that said, I want to welcome our guest, Michael Orwitz, principal, founder, CEO, El Presidente, as we call him, of OSM Investment Company in Los Angeles. Michael, welcome to the show.
Nice to be on the show.
Yeah, so thanks for joining me. I appreciate you coming on. OSM Investment Company is I don't want to say full service, but close to full service real estate investment management company. And you guys dabble in a bunch of different things. I guess give us a little background.
Graduated from UCLA, and that's how I met Barry. And we have both taken different paths in our pursuit of a real estate career. And so shortly after I graduated from UCLA, I worked for a large national syndicator of apartments, and it was the 10th largest landlord at the time, owning about 35,000 apartment units across the United States. And I worked there for about 8 years after I graduated from school. And then I decided to venture out on my own, and I was fortunate enough to have them as my equity development partner in the first handful of apartment deals that I pursued on my own.
You started in Los Angeles, and then as things have grown, and you started with the multifamily, you've grown really statewide, and then also have stuff outside of the state across the country, and then dabbled in different aspects of the real estate market in terms of other types of real estate. What made you, I guess, transform from the apartment side of it into where you are today with the various different aspects of the company?
I started in affordable housing, and that gave me an opportunity to learn about tax-exempt bond financing, low-income housing tax credits, and various other government subsidies that really encouraged the development and investment in affordable housing. And so once I got my portfolio started and my acquisitions going, we started to look for other opportunities in conventional housing, and that led to some student housing, mostly around Chico State and some around USC. And then that also got us into doing some senior housing. And so it gave us a platform as we expanded our portfolio in Los Angeles and in Central California, in Northern California. We started to see other opportunities in other types of real estate where we already had a geographic footprint. So we also looked at doing some self-storage projects as well as some retail projects. And we have since grown to almost 3,000 apartment units in California, Nevada, and Tennessee. And we now have a small retail presence in each of the geographic areas where we currently own apartments.
Yeah, so I mean, it's really grown and it's become its own animal. And today it's 60 plus properties in a wide geographical area and different genres. And so I always enjoy talking to you because when we chit chat, you're one of the few people that has as many problems as I do. And then you seem to make me feel a little bit better, as opposed to when I talk to other folks, they always say, "Oh, you have a lot of drama going on, and you made me feel better about my day." And so at least you're one of the few people who can sympathize with what I deal with all the time because you're doing the same thing.
We have shared experiences and misery likes company.
Yeah,
so that is correct.
The good and the bad. And we have traveled other parts of the world together looking for real estate deals and a good time. And so I appreciate you coming on the show and sharing your thoughts with us. Let's delve in. I want to sort of take it in pieces. I always enjoy the apartment side of things. Let's start with that. And I guess the one question that I want to ask you is, so you own a bunch of stuff in Los Angeles and elsewhere, but with all of the things that have gone on, beginning with COVID and the moratorium and the no eviction and tenants don't have to pay their rent and rent control and all of these other things that are going on in Los Angeles, what is your view of investing and continuing to own in Los Angeles going forward? I mean, does it make sense to continue to operate in LA, or is it time to get out and go someplace else?
That's a very complex question to answer, and I will do my best. So we own about 500 units or 600 units in Los Angeles. Through the pandemic, Los Angeles was the most challenging. Los Angeles passed one of the most draconian rent moratorium and eviction moratoriums in the country. And it also lasted a very long time. In fact, it just finally expired in March of this year.
Of this year, right? I mean, that's 3 years from when it started.
Correct. And personally, we had some properties where almost 75% of the tenants were not paying rent. And from some information that I recently read in the Los Angeles Times, there are estimates that almost $1 billion worth of rents remain unpaid during the moratorium, and the likelihood of collecting it is going to be very low. We have hired an attorney to come work in-house as general counsel to assist us in navigating the complexities, not only here in Los Angeles, but in other areas where we own property, to follow through on the unlawful detainers against the tenants who continue to not pay rent. And in Los Angeles, they have up to 1 year to repay the rent that they owe. However, you can't evict them for the unpaid rent. We can only evict tenants for unpaid rent from after March 31st. So we have worked very hard with our in-house counsel to advise and to encourage tenants who owe us large balances with the likelihood of never being repaid to try to enter into repayment agreements and to find alternate housing. And we've worked very closely with those tenants who have had challenges, and we've worked with repayment plans. So you ask a good question, what is the investment analysis going forward? And from that perspective, at least now that the moratorium is over, there's a much clearer picture as to what the rights of landlords are with respect to the tenant landlord. And we've started to look at deals, but I think the bigger challenge is not so much the rent moratoriums, which have now ended, but what is the financing environment like with the higher interest rates, and a lot of the lenders who were very active in lending in Los Angeles, such as First Republic Bank and PacWest, are no longer viable options for financing. So I think that's really become a more significant factor in our analysis of doing additional acquisitions in Los Angeles.
And so my other part of the question is, and we've had other folks on the show, I've asked them the same thing. I'm curious to your thoughts. So do you continue to own in Los Angeles? Or do you just get rid of what you got and go buy elsewhere in Tennessee where you have stuff, or other parts of the country where it's more landlord friendly, I'll say, and easier to navigate? Or is the real estate market itself in Los Angeles such a prime market with the lack of good housing that long term it's still just a good investment and it's going to go up at the end of the day?
So we are not selling any assets in Los Angeles. We've owned many of our assets for many, many years, and they have continued to perform well despite the challenges with the rent moratoriums. And fortunately, we have low leverage on most of our properties, so we were able to manage the non-payment of rent pretty effectively through the pandemic. And what we're seeing today is rental rates that exceed what they were pre-pandemic, and we have wait lists for many of our properties, and as soon as apartment units become vacant, we have a lot of activity and interest expressed in our apartment units. So from that perspective, I think the market in Los Angeles will continue to be strong. It is a very compressed market with a lot of demand and a lot of good economic drivers. And even though, we read in the papers about this exodus of residents from California to other states like Florida or Texas or Nevada or Tennessee, and it's true, there's so much housing demand in Los Angeles that it really has not seemed to impact our portfolio. So long term, with the ending of the eviction moratorium and with what we're seeing with our strong rental growth in our portfolio, we are looking for opportunities in Los Angeles, but the challenge really becomes the financing, and that's a challenge throughout any properties that we're looking at. Our underwriting model has just changed dramatically.
And what do you think about cap rates? I mean, obviously interest rates are up; they're close to double what they were a year ago, and yet cap rates across Southern California are still in the 3s and the 4s, and maybe you get something in a 5. But I mean, you have an inverse curve between the interest rate, which is more than the cap rate, which means that if you're going to go get financing on it, you're actually cutting into your return. And so, to me, we both, we're economics majors. That dog doesn't really hunt. And so do you believe that cap rates have to come up, or is there just so much money chasing so few deals that the stuff is still selling? Because I find that the lender that looks at the pro forma rent and doesn't give it the same, I guess, credence that it did a year ago, because they're going, look, you can't really raise the rents because you can't get the tenant out and you have rent control. And if you do get the tenant out, you got to spend a bunch of money to remodel it. And so you have to factor that in.
Correct in every respect. That's the primary reason why we haven't purchased anything in Los Angeles in the last 24 months. And it's been that situation for a while where cap rates were lower than borrowing rates. And you're correct, a lot of investors had the model of buying older buildings and either paying tenants to relocate or through attrition, renovating units as tenants left on their own accord. And that model doesn't really seem to work any longer because of more strict rent control and protections for tenants that have been passed in places like San Francisco and Los Angeles. And those same restrictions don't really exist in other states such as Nevada and Florida and Tennessee and Texas. And that's why a lot of capital and investment has moved to those states. But at the same time, there are opportunities that will arise from those challenges where people may have purchased properties with a model that doesn't work anymore and may have a loan coming due. And that's sort of the type of opportunity that we look for. And so, Barry, you're correct. We're a private company. It's our capital, just like for yourself. And so we can pick and choose the type of deals that we do, whereas maybe some of these large equity funds, they raise a lot of money from institutional investors.
And they have to put it to work.
They have to place the money. And so they're going to, place the money regardless of what's going on economically. And maybe that's one reason why some deals are still getting done at low cap rates, because they have to place the money.
Right. And I guess that's really the question, because you hit the nail on the head, which is I'm not forced to make a deal. I'm not running to make a deal. And I do think that there's going to be some pain out there, and it may still take some time because there really is still pent up demand for apartments throughout Southern California. So it's not like you can't, before you could just hold up your hand and you'd have a wait list and you'd fill the apartments. And it's not as ridiculous as it was before, but it's still certainly very tight if you're a tenant looking for a good quality place. I think the perception out there, I'm curious what your thoughts are, from the tenant's perspective is, hey, the economy's struggling, we're going into a recession, interest rates are up, prices are not what they once were. And so what we've seen is people starting to haggle, right? And people offering stupid things like, I want, the asking rent on apartments $4,000. Would you take $3,000? And these things are like, no. Or you have a no pet policy and I have 3 dogs, and would you take my 3 dogs with no pet rent and no pet deposit? And those people are, I think, not living in reality. They should go to Anaheim and hang out at Disneyland and Fantasyland. But there is still pent up demand. But at the same time, I do think that the operator of real estate who bought something with a flawed model or bought something thinking prices go up forever, or I can just hold up my hand and rent it, and then one day he can't do that, those are the people you and I want to talk to.
That's correct. And we're starting to see those opportunities as well, especially on some listings that have sat for a long time, have gone stale. I think there's two types of sellers out there, those who are realistic and those who are unrealistic. And naturally, we're looking for those realistic sellers where they recognize that the marketplace has changed, financing has changed, the leverage for loans have changed. And in fact, we recently purchased some single-family homes that from a seller about a year ago, and he carried back the financing at 5% for, I think it's 3 years. And at the time, our acquisitions analyst thought that was a little bit expensive, 5%. And I sort of thought the opposite because the Fed was already, raising rates and signaling that they were going to be raising rates. And I thought, 5% carry back financing without any covenants and conditions or appraisals or heavy underwriting by a lender was a perfect deal. And in hindsight, I couldn't be more pleased with having made that decision. And I think those may be the types of creative financing that buyers such as myself and maybe yourself, the private individuals or the smaller organizations can look to sellers for financing as well. And there are, I think will be some unique opportunities that I'm looking for as well.
I agree. I mean, I don't want to one-up you, but I did one of the similar, and the rate was 3.5% and was right as the interest rates started to move. And it was an older seller, and he just wanted security of coupon clipping, and he couldn't get it in a triple net investment because those cap rates were very low and very competitive. And didn't want to buy apartments or something else, just wanted a check. And so somebody who has the capacity to do that and then give them a decent amount of money up front and just make the problem go away. I think the other will be, the pressure of selling, whether there's a death in the family or a divorce or my loan is coming due. Those will drive some better deals as time goes on.
But the loan coming due is going to be a significant one. We have purchased loans from some financial institutions and some debt funds. And it's been a business that we've tried to expand, but unfortunately our line of credit for buying notes was recently not renewed from one of the lending institutions that has been under financial pressure. I'm not going to say which one. But we are in the process of replacing that line of credit with another financial institution. And so we sort of have a little bit of an optic into, some of those pressures because most of the loans that we're buying are maturity defaults. And again, that's where I think for someone that's playing in the field that we play in is where there are those types of distressed opportunities. Certainly we can't compete with, the big institutions like the Blackstones who are buying, very large portfolios. I read this morning about Kennedy Wilson buying a $2.6 billion portfolio, but in the $1 to $5 million range, we can be very competitive and find opportunities on apartments and retail properties with the hope of either getting paid off at maturity, or if not, we foreclose on the asset and hopefully purchased it at a lower than market basis.
And don't you find that the activity in deals that are out in the marketplace, if you would have rewound 12 months ago or even 6 months ago, where somebody might have 5 or 10 offers on a property or 5 or 10 people looking or circling around, there's only 1 or 2 now. And if they're telling you that they got 10 offers, they're not all real or serious, and they're bottom fishers. And so I think that bodes well for a real buyer who's got real money, who's sophisticated, who gets it. Because you and I are both doing stupid things when the market was just going crazy, just to compete, overpaying, putting up big deposits, waiving contingencies, things that a normal person would just never think of or do, and you had to do it.
And Barry, you identified one of the really important items. People were doing non-contingent offers and no financing contingencies. And today, I believe there are a lot of opportunities to put those conditions back into purchase contracts, to have the opportunity to do, thorough due diligence over a 14 or 21 day period, and put in a financing contingency as well, which was almost unheard of the last couple of years. But I think today with the rise in interest rates and some of the lenders that are no longer active, I think that's a really important item to for any purchaser to try to negotiate with the seller and to have the time necessary to obtain all the financing options out there or seek them, because in some cases there still are some lenders that are being very competitive, and I think those are important aspects of any deal today. So I think that's exactly right. There's desperation on the seller side, not on the buyer side.
Well, and the reality of it is, it used to be that the seller didn't really care if they closed quickly. They would push you. They would try and run it up. They would try and make you remove all the contingencies. And now what we're seeing is what I'll call the retrade, right? And so, my lender came back and raised the rate. My lender did this. And so now you have a guy who's out there who you can't feel or touch as the lender, and then you basically blame it on the lender, and people come back for a retrade. And so it's also perception of the deal, I think, right? So if you rewind, the perception of the deal was, I have to pay full price. I have to do things that I wouldn't normally do to separate myself from somebody else who would be a crazy, stupid buyer who would do something that would be unheard of, to now it's, hey, I'm going to come back and massage it. And really time is on the buyer side. On the one hand, you may pay more in interest rate. On the other hand, I don't think the seller's got 5 people lined up and the threat of, I've got a backup buyer. If you don't step up and do this right now, I'm going to go to this other guy. That doesn't sway me in today's world.
You're correct. The buyer holds a lot of the cards today. And I think, in terms of trying to negotiate the best deal, it's during the due diligence period and getting your financing that you have opportunities to go back to the seller and negotiate better pricing, because it's either, your rent collections aren't as good as it was presented to me, or the rent growth isn't quite as strong as I thought it would be, or your property condition is
right. You just
lower quality than I thought it would be, and we have some, more expensive capital improvements, and contractors are charging more for those costs, and of course it's the financing. So I think there are a lot of legitimate.
They're all true. I mean, they're all real things.
Deals.
Yeah, they're all real things that somebody should take into consideration. You just didn't have any legs to get anywhere with it before, and I think you do. Let's switch gears for a second, because we got a lot. You and I could go all day. You have retail properties, you have hotels, you have student housings. Let's touch on those briefly while we have time. So let's start with the hotel, something near and dear to your heart. You guys have been in the hotel world, in what I'll call the boutique, smaller hotel in Los Angeles for a while, and I don't want to put words in your mouth, but all kinds of challenges, not only from COVID, but from labor laws, wages, operational issues, construction costs, supply chain. Where do we stand today, and what are the biggest challenges in the hotel world that you're seeing?
So I just have a very small snapshot and window into the hotel business, and I find it to be a very challenging business as well, particularly in Los Angeles, and I understand it's much more challenging in San Francisco because of the decline in tourism. But in Los Angeles, the hotel industry was severely impacted, as all hospitality was during COVID, when our occupancy rates went down into single digits. And this is a hotel that was operating at 90% occupancy. And so it was a pretty dramatic change. So we had to cut labor very drastically in order just to try to make ends meet. And as the pandemic restrictions ended, certainly then business rebounded. And it's gone in fits and spurts. It's been a combination of tourism, then it's been a combination of business, and then the two get blended and blurred together because people now tend to work more remotely than they did in the past.
Sure.
So we've adjusted our marketing to try to make our hotel more appealing to that business traveler that's also planning to mix in more leisure, and vice versa. People who are on leisure trips are also mixing in more business. And so our hotel has really rebounded, and we're now running at about 85% occupancy. Our room rate has rebounded significantly, not quite to where it was pre-pandemic. But now the big challenge is as you've identified, is the labor costs. The city of Los Angeles has recently passed what's called a housekeeping ordinance, which severely limits the number of rooms that housekeepers can clean. And this ordinance has also been passed in West Hollywood and Santa Monica. I'm sure there's pressure to try to get it passed in Beverly Hills. And so the labor costs have increased dramatically. And so that's been a challenge.
So, and not to interrupt you, but so what's the logic behind limiting the number of rooms that you can clean? I mean, I get it when the airline does it and says we're going to limit the pilots the number of hours they can fly because they might be fatigued and kill people. But what's the logic behind limiting cleaning a room?
Well, it's a very labor-intensive job to clean rooms, and I imagine it was originated because there were probably some hotel owners or motel owners that may have had practices that were not in the best interest of the employees. I can speak personally. Our hotel is managed by a very large hotel operator, very large national and publicly traded hotel operator. So their labor policies and procedures were much more conducive to taking into account the wellness and benefits and health of the employee workers, but that's not the same for all hotel owners and all hotel management companies. So I think the labor unions were very influential in getting these housekeeping ordinances passed as a way to try to protect housekeepers in hotels that were non-union. And so a lot of these restrictions are sort of similar to unionized hotels. And from what I understand, there's also a new resolution pending before the city council to also further increase the hourly wage for hotel workers, where I believe it's going to be raised to $25 an hour. And then it will be raised $1 an hour per year through the date of the Olympics. So
by the time the Olympics come, somebody cleaning hotel rooms could be making $60,000, $70,000 a year in Los Angeles.
Yes. Also get paid overtime. Right. Yes, it will become a high-paying job.
Right. And so I guess the simple answer is, look, in order to be able to operate a hotel and in order to be able to meet the demands of rising operational costs, is that not then either A, passed on to the consumer in just higher room rates, if you can do it, and if you can't, it's just right off the bottom line as the owner investor?
It's very difficult to make ends meet unless you're a luxury hotel. So what we're trying to do is upgrade the quality of our hotel to be more in line with a luxury hotel so we can further push room rates, because unless we can push room rates higher, it is very difficult to cover those additional labor costs. Yeah. And so if you're a middle tier or a lower scale hotel, it's even more difficult because there's less pricing opportunity to raise room rates. Whereas with luxury hotels, the people who are staying at those hotels, price is rarely an issue for them.
And what I found also just in my own travels is that if you have a hotel that's more geared towards a business clientele, you'll find that the rates are higher during the week and then lower on the weekend because they have less traffic, and vice versa. That would be a typical example would be Las Vegas, where you can go and stay during the week for a fraction of what it costs you if you just want to go Friday to Sunday.
So we try to even it out. So we have a strong business presence Tuesday through Thursday, and then our hotel appeals to the leisure traveler visiting Los Angeles for the weekend, Friday through Sunday. And Sunday, Mondays are usually what we call our shoulder days, where we have the lowest level of demand, and then it spikes right back up Tuesday through Saturday. So we spend a lot of time trying to figure out packages and offers to fill up the hotel room Sunday, Monday. But we have to do well 7 days a week, 24 hours a day.
To make it. Yeah. I mean, it's a constant. It's every day of the week. So let's just talk briefly, because we got a couple minutes left. I want to talk student housing, because I know you are in that. In some instances, we are in it together. And while the universities are all back, they're open, kids are back at school, the whole COVID issue of people not showing up to classes and doing it virtually is over. What is the prognosis for student housing moving forward? I mean, is that a segment of the real estate market that you feel like really has promise going forward?
We like student housing a lot, primarily because we obtain guarantors on all of our leases from the students' parents. So we have very good collection. So throughout the pandemic, with all the restrictions and rent moratoriums that were passed by cities, counties, state, federal, we had almost perfect collections at all of our student housing. So from that perspective, student housing performed very well during the pandemic. And even during the period when people were studying from home, students wanted to be near campus. They wanted to have that interaction. They wanted to have that college experience. And so we found it to be very resilient. And now that we're, past COVID and the moratoriums and the restrictions have ended, we're finding that the student housing continues to perform well. So we like that space quite a bit.
And it's location. I mean, if you have a good location for the student housing with proximity to a university, and then there's built-in demand because of it,
right? Then it's almost like beachfront property when you're close to a university.
No, I agree. I mean, it's like owning retail on a main corner. Like if you've got the spot, people want to be there, and there's demand. And while there's heavy turnover and re-tenanting costs and fix-up, it is a built-in market. I like it. I mean, I think long-term it's here to stay.
Yes, the universities are here to stay, and we like being near the big public universities and the large private universities, and those are the colleges that are popular. And yes, if you can manage the turnover costs
and keep the parties to a minimum, right? Then you'll be all right.
Keep the parties to a minimum. Yes, and don't allow too many beer pong tables in the living room. So we have to manage that as best we can.
Yeah. So real quick, your perspective on the economy as a whole. Interest rates higher or lower than where they are today by the end of the year? Or the same?
I think likely about the same.
And lending, the ability to get a loan, the requirements from a lender, more difficult later in the year, the same, easier than they stand today?
I think it will continue to be a challenge, but I think projects that are low leveraged and by strong sponsors with experience will continue to be able to get loans at competitive rates. I think lenders are going to be less inclined to lend to lower quality borrowers and to those with less experience. And I think that's why there are a lot of these debt funds that have money, but it's much more expensive money. 8, 9, 10%. So I think anybody who has a highly speculative deal or anybody who doesn't have experience is going to have to borrow at a much higher rate.
Yeah, you're going to pay a premium. And finally, cap rates, the same, higher or lower? And I realize that's a big, broad question.
I think those are going up. I think cap rates are going up.
I think they have to, right? I mean, I think it's been a slow move, but I think there has to be some moves at the end of the day. It's just not, they're not in sync with where interest rates are and borrowing ability. So
agreed.
I told you to go quick. It always does. We are unfortunately out of time. You and I could go all day. I need more coffee and some breakfast, but I do appreciate you coming on and sharing your thoughts and talking about your business, and always good to catch up with you and chat with you, and look forward to seeing you in person soon. I do want to wish you and your family and your business much continued success in the future. And again, appreciate you coming on the show.
Thank you, Barry, and I appreciate being invited. I enjoyed it thoroughly, and I hope your listeners were able to get some additional insight into the real estate market, and I look forward to coming on again sometime.
Yeah, so nothing better than two old guys just talking about what the heck they've been doing during the week. So for those of you out there, thanks for tuning in. I appreciate it. I am Barry Saywitz, president of the Saywitz Company. I want to thank all the folks here at OC Talk Radio, as always, for helping us put on the show. If it's Tuesday, we will be back here again next Tuesday talking more real estate. We'll see you then. Thanks for tuning in.
There you have it. You've been listening to Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current state of the real commercial real estate market right here in Southern California. On Orange County's only community radio station, OC Talk Radio, streaming live from our studio here at the University of California Irvine's Beale Applied Innovation Center.